Welcome to the Deep Dive. We take stacks of information, find the key nuggets, and get you well-informed, fast. Today, we're tackling something that trips up a lot of people, especially non-resident Indians, or NRIs. That's property taxation back in India. So our mission today, let's demystify the latest 2025 tax rules for NRIs buying and selling property there. Whether you're thinking of investing, planning to sell, or maybe you just want to get a handle on the current landscape, we aim to clear things up.
Exactly. And what's really key here, I think, is how these rules specifically hit NRIs. It can change based on, the property type, how long you've actually held it, and some of the recent changes in the law. We'll walk you through the basics, the must-knows, hopefully giving you those aha moments in what can seem like a pretty complex field.
Okay, let's start with buying. If you're an NRI looking to buy property in India, what are you actually allowed to purchase? Any surprises there?
Well, generally speaking, you can buy residential or commercial properties. No problem there. But, and this is crucial, NRIs typically cannot buy agricultural land or farmhouses or plantation property.
Okay.
Unless, of course, it's something you've inherited or maybe you got specific approval from the RBI or the government. But that's the main restriction to flag.
Good to know. So say you found the property, you're good to go. Then there's this thing called TDS tax deducted at source. When NRI is buying, who does what? How does that work?
Right. TDS. It really depends on who you're buying from. So scenario one, you're an NRI buying from a resident Indian. In that case, there's a 1% TDS.
Yeah.
But that only kicks in if the sale value is more than 50 lakh rupees.
Okay, 1% over 50 lakh buying from a resident. Got it.
Exactly. Now, here's where it gets, more interesting for NRIs specifically. If you're buying from another NRI, the TDS rates are totally different. It links to the seller's capital gains. So it's 20% if the seller held the property for more than 2 years.
That's long-term capital gains rate.
Precisely, LTCG. And it jumps to 30% for short-term gains STCG if they held it for less than 2 years.
Wow, quite a difference.
It is. And importantly, the buyer, in this case, you're the one responsible for deducting that tax and depositing it with the government within 30 days.
So the buyer acts almost like a tax agent in that situation.
You could put it that way, yeah. It ensures the tax on the gain is captured up front.
Okay, that's a really vital point for NRI buyers. Now, let's flip the coin. What about selling property in India as an NRI? The big one here, I assume, is capital gains tax.
Absolutely. That's usually the main concern. And again, how long you held the property is key. If you held it for over 2 years, it's long-term capital gain, LTCG. Now, there's a recent change. For properties transferred after July 23, 2024, the base tax rate is set at 12.5%.
Okay.
But if you acquired the property before that date, July 23, 2024, you actually have a choice.
A choice? What kind of choice?
You can choose between paying 20% tax with something called the indexation benefit or paying 12.5% without indexation.
Okay, hang on. Indexation benefit. Can you break that down a bit? Sounds technical.
Sure, yeah. It's actually a really valuable benefit. Indexation essentially lets you adjust the original purchase price of your property upwards to account for inflation over the years you held it.
So it increases your cost base.
Exactly, which means your calculated profit, your capital gain, becomes smaller. So even though the 20% rate looks higher than 12.5%.
Well, with indexation, the actual tax you pay could be lower because the taxable amount is reduced.
Precisely. You got it. It often works out better, but you need to run the numbers. And always remember, on top of that base rate, whether it's 12.5% or 20%, there's a surcharge, which depends on the income level, and a 4% health and education cess. These get added on.
Right, those extras. So the effect rate could be higher.
Yes. The effective LTCG rate could land somewhere between roughly 12.5% and about 23.92% all in.
Okay. And what if you sell quickly within that 2-year mark?
That falls under short-term capital gains, or STCG. It's treated differently. The gain is basically added to your other income taxable in India and taxed at the regular slab rates applicable to you as an NRI.
Which can go up to?
Up to 30% potentially, plus the applicable surcharge and that 4% cess again. So potentially quite high.
And TDS on selling, how does that work from the seller's perspective?
So when you're the NRI seller, the buyer is obligated to deduct TDS. This is under a different section, Section 195. The buyer deducts tax at the relevant rate, the LTCG or STCG rate, but importantly, it's calculated on the capital gain amount itself, not the entire sale price.
That's a key distinction, not on the whole transaction value.
Correct. And for LTCG, keep in mind that surcharges on the TDS kick in if the total sale amount, the consideration, is over 50 lakh. Budget 2022 capped this surcharge at 15%, though.
This sounds like it could add up to a significant tax bill. Are there ways to reduce this, maybe by reinvesting the money?
Yes, absolutely. And this is where planning can make a huge difference. The Indian Income Tax Act offers specific exemptions if you reinvest the capital gains. For instance, Section 54. If you have a long-term gain from selling a residential property, you can avoid tax on that gain up to a limit of 10 crore now if you reinvest it into buying another residential property in India within a certain time frame, typically 2 years after selling, or construct one within 3 years.
10 crore limit. Okay. Any others?
Yeah. Section 54 EC is another popular one. This allows you to invest your LTCG from any capital asset, not just property, into specific government bonds, like those issued by NHAI or REC. You have to do this within 6 months of the sale.
6 months for the bonds.
Right. And there's also Section 54F, which is a bit different. It lets you claim exemption on LTCG from selling something other than a house, provided you reinvest the entire sale proceeds into one residential house. There are conditions, like you shouldn't own more than one other house.
So options exist, but they have strict rules and timelines.
Very strict. You need to be precise and act within the window. It's not automatic. You have to claim it and meet the conditions.
Got it. Beyond taxes and exemptions, what other sort of general things should NRIs be aware of when dealing with property in India?
Well, stamp duty and registration charges are unavoidable. They're the same for NRIs as for residents, but they do vary significantly from state to state. That's a cost to factor in.
Right, state-level costs.
And something really important, double taxation avoidance agreements, or DTAAs. India has these treaties with many countries. They can be incredibly helpful. Basically, they aim to prevent you from being taxed on the same income in both India and your country of residence.
How does that work in practice?
Typically, you might get a credit in your home country for the taxes you paid in India on the property transaction. Or the treaty might specify which country gets the primary right to tax that income. You need to check the specific DTAA between India and your country of residence.
Definitely worth looking into.
Absolutely. Oh, and one more thing on TDS. Remember, the buyer has to file a TDS return. That's crucial for the NRI seller because that filing is what allows you to claim credit for the tax that was deducted from your payment.
So the buyer's paperwork enables the seller's tax credit. Interlinked.
Very much so.
Okay, we've covered a lot: buying, selling, taxes, exemptions, DTAAs. So wrapping this up, what's the main takeaway for you, our listener, trying to navigate Indian property investments?
I think the main thing is, while we've outlined the 2025 rules as they stand, these laws aren't static. They can change. New regulations come out. The union budget might bring adjustments. What's really fascinating, or perhaps challenging, is just how dynamic this whole area is. Understanding the principles is key.
Right. So maybe the provocative thought to leave you with is this. In this world of constantly shifting financial rules, being truly well-informed isn't just about knowing today's regulations. It's about recognizing the absolute need to get professional, personalized tax advice before you make any significant property moves in India. This deep dive gives you a solid foundation, the key concepts, but always, always verify with an expert for your specific situation.